Now, Robert, our first question here comes from Sylvia R. from Inside the Rich Habits Network, and it hits home with me. I love this question because I think a lot of people are beginning to take notice. So let's read the question and then have a quick discourse about it. Now that we are in this big historic bull run, I have a question on taking profits. I slowly started investing into single stocks and cryptocurrency earlier this year. Robert and Austin have been talking about your profit-taking strategy, but my question is, if I'm putting in $200 to $300 a month and I'm dollar cost averaging into some of the most popular stocks and cryptocurrencies, when do I take a portion out? Do I hold the full shares? Do I take off fractional shares? Do I keep it in my bridge account for the next 8 to 10 years? How do I think about this? So, Robert, before we dig into our profit-taking strategies, which by the way, we've been sharing inside the Rich Habits Network for quite some time now, let's just take a moment to say, oh my gosh. Bitcoin, as we're recording this, is at $91,000. Palantir, as we record this, is at $60 plus a share. Tesla is at over $350 a share. You know, the S&P hit 6,000 points for the first time in history. All these things that we've been talking about and trying to just shake people's shoulders and say, be an investor, be an investor, be an investor, put money in the markets. We are not in a bear market, right? Bears sound smart. Bulls make money. I like to make money. I don't care how smart or dumb I sound if I'm making money. So at the end of the day, Robert, I just want to have a quick round of applause. Congratulations to everyone who's been sticking with us now since February of 2023 and dollar cost averaging into these markets, into these asset classes, into Bitcoin specifically, right? It's up 110% just this year. It's just so cool to see all of this awesome green in our portfolios for the first time since really we started making this podcast. Like, don't get me wrong, we've had a bull market, but I mean, geez Louise, dude, it has been a ton of fun.
It's great for us as well because we've been out here shouting from the mountaintops of what we think's going to happen, giving people all of our best stuff. You know, we're here to educate and hopefully guide and nudge people in the right direction. So these are fun times because everyone has put in the work. We hope that they've been taking notes and taking action. They've been dollar cost averaging along the way, and that gets us to this point. We've all been accumulating, and now we get to the fun part, going into this bull run and really starting to build our portfolios and see all the hard work pay off. So this is what it's all about right now as we film this episode.
And so now to answer Sylvia R's question specifically, to give you all a little bit more context as to how I approach investing, I like to use this sort of core satellite strategy. So the core of my portfolio, right, let's call it 80% of my portfolio's value are ETFs and blue chip stocks because I want to make sure that I'm vastly invested into companies and indices that have a long track record of growth, profitability, and trending up and to the right, right? That is a great way to invest your money, is have a lot of it in things that tend to go up. That's just point blank period. Now the other, let's call it 20 to 35%, I consider my satellite portion of my portfolio, which is the more riskier ideas, right? These are ideas. These are opportunistic, single stocks, cryptocurrencies, alternative asset classes, things that I think can have outsized returns than just the S&P 500 and other blue chip stocks. Think about this as your On Running. Think about this as your Palantir, I would maybe even say Nvidia, although they are pretty blue chip at this point, right? But think of this as the Bitcoins of the world, the Solanas, the Ethereums, the Chainlinks, right? The ideas that, okay, risk-adjusted returns seem very favorable to have some allocation into these specific names. My entire investment strategy and thesis here is to have a bunch of money in these blue chips, have a sizable amount of money in these really cool opportunistic names, make money opportunistically in those names, sell those names, roll them down into the blue chips and the other indices, and then as I deploy net new capital, put that opportunistically where I want. What that means for Sylvia R here is that as you continue to build up your portfolio, you have a lot of it, to your point, in some of these popular stocks and these blue chip names, but you also opportunistically have some in this Bitcoin and Ethereum and a little bit of these other names that you mentioned. And so if I were you, I would say, okay, I have my $100,000 base. I'm up X amount of money on Bitcoin. I'm up X amount of money on Ethereum. I have these very specific price targets that I give myself to begin to sell and realize some of those profits. And then as I realize the profits, I pay my taxes, and then I take that whatever amount of money it is for you and roll it into the S&P 500, roll it into the Magnificent Seven, roll it into VGT and VTI and these other great sort of core pillars that make up a profitable long-term portfolio. That's my strategy. That's how I'll be approaching this bull run. I'll be opportunistically taking profits on a ton of these names, rolling them into the awesome blue chip stocks and index funds we love. And then as I have net new capital, deploy it opportunistically into these fund names as well. And then as those do well, I'll do the same thing.
So definitely that was a mic drop moment, Austin, and I'm going to add a little bit more to it. We definitely want to make sure everyone understands what Austin spoke of. He's not out there selling his S&P 500 and some of the blue chip things that he has talked about, these vehicles that are always in our portfolios. He is kind of doing a rollover strategy where he's taking this net new capital, adding it into some of these, high flyer stocks like you have and how we've mentioned in the past. And then what he's doing is taking some of those profits and rolling it into those blue chips, like our retirement accounts is what he means. And so the other day in the Rich Habits Network private live, I discussed my profit-taking strategy, and it's just really simple for me, and it's adjustable for everyone. Everyone's numbers can be different, but how I try to look at it is once I'm up 50%, I take 25% off the top. Then I let the rest roll. Then once I'm up 50% again, I take 25% off the top. And I will do that depending on the company because each investment is different. I will do that over and over again until I get to a point where I have my original investment out of the investment and I'm playing with strictly house money. Or sometimes I might stop it at 1 or 2 drawouts from this investment because I feel so good about it still moving forward in the growth like I feel about NVIDIA, Palantir, OnRunning, and some of the other stocks we talk about. So everyone's risk tolerance is different. So adjust your profit-taking strategy to where you feel the most comfortable. You might put it in a situation where when you get up 20%, you take 10% off. Everyone's is different, but I hope this illustration helps you understand what I do in this instance and what Austin does, because then that way you can build a thesis around your investment style and stick to it, because that's one of the key things is making sure you stick to a plan and then also being consistent. So I love this question, Sylvia, and I hope this helps.
I love that, Robert.